Hey everybody, it's Nate. Doing my lunch break with Nate series. So sorry for the late start today. Had a couple things we had to get through. So just wanted to wish everybody a happy Easter, day after Easter, and hopefully everybody had a great day yesterday. We had some good weather and the good weather before as well. So all those walks that everybody's doing out there on a consistent basis now. I'm sure it was fantastic for everybody to be able to get out and kind of walk around during the holidays. So a lot of good stuff to talk about today. Just going over a few items to note with the market. I did want to get into today. I wanted to get into a lot of questions that people have been asking me about the market in general when it comes to how are we, how does this relate to other times we've had situations with market fluctuations and things like that. So I think it's I've been answering this question a lot, and I figured it'd be a good topic to bring up on the show today. Couple quick items of business. So the market, as of yesterday, we have 16 new listings. So down from the average that what it was last week, but about what it has been since the whole thing kind of started. So we have Lot, Avon, Chili, Clarkson, Greece, Rondecoit. Looks like we got a few in the city as well. Supposed to have some nice weather this week too, so maybe sometimes that has something to do with it. Again, as we move forward with everything, as long as we are practicing kind of using our virtual tools that we have available to it, people are still buying houses out there, and people are still listing houses. So I got one coming up this week that I'll be telling everybody about, and then I wanted to just kind of tell you a success story about property that we had on the market over the weekend. So we were able to do everything virtually. We were able to do the virtual tour. We were able to utilize the Dream Home virtual tour, and then also a Zoom conference call for several showings from the seller's house. So we would have a bunch of people would call in on a Zoom call, walk them around the property, make sure that we're asking questions in real time about the property. So one of those things that we're trying to use as much tools as we can to make sure that the experience is as close as possible to the real thing, and giving people as much data as we can about the properties so that they can make an educated decision. And we ended up having 5 offers on that property, and it was kind of the way that we kind of planned it out a lot was the perfect way to do it. So obviously we have to get to the finish line now, but it was a good kind of a reinforcement of how we're doing things, and making sure that everything is working appropriately, working smartly, working healthily, if that's even a word, trying to promote the good health that we're all trying to social distance ourselves. And by utilizing these tools, we're definitely putting ourselves above the competition when it comes to marketing properties. So I did want to go over, we do have the 16 listings here, and wanted to go over the market in general. So one of the things that people have asked me a lot about recently are what where people are saying that the prices are going to fall. Prices are going to fall, and I don't know if we haven't necessarily had evidence for that yet. If you look back, kind of historically speaking, we've had market fluctuations. First thing to notate about Rochester itself is that Rochester is a very stable housing market, and always has been. It's always been very steady. Part of the reason that we have high taxes is it actually stabilizes our price points. So we can't, you never see a scenario where we were having peaks and valleys when it comes to housing prices, like you would in maybe California or Florida or other places in the country. We have a very steady appreciation, so it kind of just slowly ticks up. That way, that most of the time you're not going to see crazy appreciation within a year period. It's mostly a 5 to 7 year period. And so when you look at that in context to all these market fluctuations that we've had, let's talk about the Great Recession or post 9/11, where we had these big events that would happen, these big crises that happen, and similar to what we're going through right now. When you think about the most recent one, which would be the Great Recession, that was probably around 08, 09 into 2010. And what the differences between that one and here is you had a ton of bad lending practices that were going on. So the bad lending practices were things like adjustable rate mortgages. So people were getting mortgages back when they basically told everybody to go buy houses back in the post 9/11 era. Everybody went and bought houses. They reduced regulations, and they were lending things like crazy back then. They were doing basically stated income loans, which is unheard of now. But stated income loans, where you go in there and you basically write in and you promise that you make a certain amount of money so that you can get a loan. Everybody was speculating on the fact that the houses were going to just continue to depreciate all the time. Obviously, when you're doing that and you have questionable and you potentially have questionable sorry about that, my calendar events popped up. And if you have questionable credit, obviously it's definitely a red flag potentially that could happen. Something bad could happen with the loan. So a lot of people were doing it that way, and a lot of people were in adjustable rate mortgages, or ARMs, and a lot of those started to adjust all at the very same time. So when 2008, 2009 happened, there was a ton of readjustments of adjustable rate mortgages. All of a sudden, you couldn't afford what your mortgage payment was. So that, coupled with the fact that there's a lot of bad debt out there within the banking industry, that kind of was a big house of cards and all collapsed at once. We also had very high interest rates at that time. So my first house I ever bought was around 8% interest rate. And it really took a long time for those rates to decrease down to the levels where they are today. A lot of banks relied on the interest that they were charging as part of their bottom line. So when you had now they've kind of reallocated how they charge people. A lot of it comes from a lot of fee bases. But back then it took them a while to get down to that 3% mark, which is where we're at right now. So you didn't have a big pool of buyers that could actually afford a house because the interest rates were so high at that point. So when everybody's value flatlined or decreased, but what happened was all of a sudden you had a ton of inventory on the market, a ton of foreclosures on the market, because you were having adjustable rate mortgages where people couldn't afford the payments. And all of a sudden you have a glutton of inventory in the market and not any buyers that could really buy them. So they were offering things like grants, 5-year first-time home buyer grants that was a federal program that was going towards trying to purchase houses, trying to prop up the housing industry. And it took them about 12 to 18 months to get that rate down to where it needed to be, so that all of a sudden people were starting to purchase houses at that point. So about a year, of that created that inventory issue that we had, which we had a glutton of properties back then, and not enough buyers to really buy them. The last 3 years that we've had in the Rochester market is we've had a less inventory from houses on the market. That can be attributed to a lot of things. One of the things that it can be attributed to is 10, 15 years ago, a lot of people refinanced when the rates all went down. Not 15 years ago, but more close to like 8 to 10 years ago, everybody refinanced. And so now they're sticking in their houses longer. That's happening now. Now that the rates are kind of all over the place in the banking industry right now, but they're still around that historically low rates that we've seen over the last decade or so. So people are doing that now. They're sticking around in the houses a little bit longer. People that may have wanted to sell and list their house as a luxury this year to maybe upgrade and get into another house, they're probably hanging back a little bit. And so we might not have that traditional spring market as we've always had, which is mid-February up to June. So if anything, that's contracted our inventory our shortages of inventory, which it essentially keeps it kind of even more competitive than what it was. On top of that, you have buyers. Some of them are kind of waiting this out, so you have kind of a shortage of buyers out there. So the buyers have kind of contracted too, people that actually wanted to do something. So it's almost reset the market. Everything's been balanced out. Everything is balanced out at this point. Now, where does it go from here? A lot of people ask me if this is going to become a buyer's market. I don't see that happening right now. If it does, this would be a lot longer of a process. And if it does truly start to happen, I don't think it's going to be until it would be much later in the year, so a few months down the road. At that point, we'll have a lot more data about where we're at with everything. Hopefully, these programs, where they're designed, the unemployment programs and especially the small business payroll programs, those are designed to keep people on the books. So that way, once this is all out, once we're all done with this, they can come back to work, and they don't have to be re-onboarded, so they don't have to spend money to rehire somebody. That's hopefully the way this is all going to work. And the way it relates to the housing market is you have essentially you have all these tools. So I think a lot of stuff that was learned from the last crisis when it came to the housing market was you had a lot of these tools that were developed that took a long time to kind of figure out back when everything was kind of going crazy 10, 12 years ago. And one of the things that banks have been pretty upfront with since the very beginning this time around is they've offered forbearance situations for people with mortgages where you can kind of stop paying your mortgage for a few months. If you haven't learned about that yet, definitely reach out to your bank about that and see what type of options they have available. But you would stop paying your mortgage for a certain amount of months, agree with the bank. They would place the house into a bank in forbearance. It wouldn't hurt your credit. And then they would just tack on those payments either over to increase your current payment a little bit, or they would just tack on those payments at the end of the loan so that you don't have to worry about them until, let's say a 15-year loan or a 30-year loan until you're 30 or to your 15, you don't have to worry about those extra payments. They would just add them on. So the idea is there's not many people that are not necessarily able to afford their mortgages. Everybody seems like they're still able to afford the mortgage payments, and we're not having adjustments happening that are making it so people can't afford the houses. And if we can keep the unemployment rate at a certain rate and not have mass layoffs, then we should be in good shape. So I also will say, from a value standpoint, a lot of the properties in Rochester are holding their values. So let's say that we we get through this blip, and you purchase a house, and maybe you spend $5,000 over asking or something like that. In the grand scheme of things, it's not going to be a huge situation because most people are going to be 5 to 7 to 10 years into their house. By that time, you would have had picked up the next line of appreciation. So, not unless talk to your agent about how you're doing your process, what comps you're looking at, what comparable sales you're looking at, and that way you can kind of have a sense about what the market has done historically. And that's really a big piece of what we do. We're guiding you through this process. The realtors are not selling you the house. We're guiding you through this process and giving you all the data so that you can make the most educated decision and explaining to you how the market is working. So I think takeaways from today, the market itself is there's not a lot of inventory coming on the market right now because I think people are again practicing the social distancing. The ones that do come on the market, if they're the right price point and they're in the great condition that they usually are, they're going to sell still. And so that's, when you guys are in the houses doing all your projects, doing some painting or adding things here and there to the house, definitely use this time potentially if you have the means, obviously, to do some of those some updates and upgrades and things like that. Because if and when you're ready to roll, I do think that underlying the market will still be a solid market. So the thing I think is that it's important is we got to keep monitoring how the businesses are going to keep people on the payroll books, hopefully using this payroll protection program, which was just introduced last week, and a lot of people got their applications in, and I think you'll start seeing that money kind of roll out. And that's a 2-month program that essentially we've had a couple people on the show talking about that. But that's a 2-month program that if you keep your people on the books, it's a completely forgivable. So it's a really cool program to be able to utilize in times like this. And as we start to open the market back up, then I think you'll start to see the benefit of what that did to kind of get us through this social distancing shutdown. So always we try to be positive, not to acknowledge that we're definitely in a challenging time, but it's to be innovative. That's kind of what I'm trying to do, being innovative, backing up a lot of the virtual stuff on there, and really trying to study the market and historically speaking how the market operates. There was an article just recently in I'll have to put the publication up. Maybe I could put that on to next week's show, that talked about how Rochester is one of those markets that is pretty well positioned to get through crises like that. And that goes back to what I said at the very beginning of the episode here, is that Rochester itself is a very steady market, and it always has been. And I think a lot of that, the flack that we give for the higher taxes, that does somewhat stabilize us. And then, at the end of all this, when you think about it, healthcare is one of our leading job sources in this area. And close behind that is groceries. So both considered, I would say, ultra essential in this moment. So other than that, I think that's it for today. I'm going to put I do have a new trivia question for everybody. And I'm going to put that poll out so that we can talk about, I'm going to put that poll out so we can talk about which business we want to be able to use. So I will get out the question to everybody. I'll put it in the show notes, and everybody have a great week. And if you guys have any questions or need anything, always reach out to me. Thank you so much for the opportunity, and I will talk to you later.